Welcome back to another video on the Alpha Finance YouTube channel. Today we are going to be talking about two stocks to buy, but before we get started, let me just remind you that last week we posted a 20-minute video called Stock Market for Beginners, which we believe will be really helpful if you are just starting out with investing. Go take a look and then come back into this video. The first stock we are going to talk about is Foley Trasimene Acquisition Corp, ticker symbol BFT. This is a SPAC and it is merging with Paysafe. Before we start getting into why this might be a good buy, it's important to know what a SPAC is. There are two main ways a company can enter the stock market: the SPAC and the IPO. First, the most popular way of entering the stock market is an IPO, or initial public offer. The company offers part of its shares for the first time, but this could be a very costly process for the firm. On the other hand, we have a SPAC, which means Special Purpose Acquisition Company. With a SPAC, a company enters the market through the IPO process. This company has no business activity, it simply has a lot of money for a merger and acquisition. This merger and acquisition will help a company enter the market. In this case, Paysafe wants to enter the market. It is normally backed by a well-known investor. We'll tell you who he is in our case. SPACs are also known as blank check companies because when they IPO, investors are putting money in a company with no business. This money will be used in the acquisition. Then, later on, it is announced that this company is merging with company X. When this happens, usually there is a huge run-up in the stock price. After this, the deal can still be called off before the actual merger date, but that isn't that usual. As we told you before, SPACs are known for having a well-known investor backing them. In this case, it's Bill Foley. He's an investor with a strong track record of value creation either in his companies he created, such as Fidelity National Financial, or in companies he bought or acquired through mergers and acquisitions. His team is known for having experts in payments and processing sector, which is one of the main segments of the Paysafe business. He is also known for having a great expertise in mergers and acquisitions and synergy achievement, which will help Paysafe grow. Now let's talk about Paysafe's business. If you don't already know, they are a leading integrated payments platform with a two-sided consumer and merchant network. They operate three different segments, the first one being digital wallets. Then they have eCash, and finally they have integrated processing. Now let's see what each of these segments actually do. With the digital wallet we have Skrill and Neteller. They enable customers to upload, store, withdraw, and pay funds from a virtual account. Not only this, but they allow customers to trade cryptocurrencies, which is a booming market right now. This segment is expected to have a 14% compound annual growth rate of organic revenue. What is this organic revenue? It's the revenue without mergers and acquisitions. And as I told you before, Bill Foley is an expert with mergers and acquisitions, so we can expect this number to be bigger than this. For their eCash segment, they have Paysafe Card and Paysafe Cash. This is their proprietary digital currency solutions that enable customers to use cash to pay for goods and services online. This segment has an expected CAGR of organic revenue of 8%, and once again, if mergers and acquisitions are done as they are expected with Bill Foley, this number could be higher. Finally, we have integrated processing, which is their proprietary international gateway that can process across US, Canada, and Europe. This is their main source of revenue of about 50%. It's expected to grow organically 10% year over year, but once again, this number could be higher because of Bill Foley. Paysafe is investing a lot into the iGaming market. This is the online gambling market, with partnerships with companies such as DraftKings. With the legalization of online gambling in more US states, this market is set for huge growth. Paysafe is trying to take advantage of this and expects the growth of the US iGaming market to be of 52% year over year into 2025. However, I believe this number is quite low and it will be higher than this 47 billion market cap. Paysafe are already proven leaders in the iGaming market, and I expect this to continue for years to come. They also have a big presence in other high-growth and profitable markets such as gaming, with partnerships with games like Fortnite and Roblox. I've personally seen friends of mine using Paysafe for gaming purchases. Until now, I haven't heard a bad thing about them. As this is a SPAC, we don't have all the financials yet. However, from what we've seen so far, they are looking pretty good. The volume and revenue is expected to grow double digits for years to come. Not only this, but they have great profit margins. Their revenue is also coming from a multitude of places. As you can see, it is not only diversified by segment, but also by geography and vertical. Now, as far as competition goes, we've heard this is the next PayPal, this is the next Square. Don't fool yourself. Firstly, they shouldn't be compared with Square as they don't operate the same segments. They've even told us this in their investor presentations. As far as PayPal goes, Paysafe is not catching it. PayPal is a beast. However, this is a huge market with great growth potential, so more than one company can thrive. Now, a word of warning. Blackstone and CVC are private equity funds who own part of Paysafe. In SPACs, there is a lockup period. This means that they can't exit their positions until a certain date. However, after this date, they are expected to sell. So what does this mean to BFT or Paysafe stock price? During the weeks and months leading to the merger date, and for a few time after the merger takes place, the price is expected to increase. However, when Blackstone and CVC are able to, they will most likely sell. This isn't because they no longer believe in Paysafe. It is because of the nature of their business, the one of private equity funds. This sale might decrease the price of the stock temporarily, but this does not mean that you should worry. It's simply for you to be informed. Now, to conclude, Paysafe is in a market poised for huge growth for years to come. Digital wallets, e-cash, integrated processing are not only the future, but also the present. Usually, I wouldn't invest in SPACs. They are usually newly formed companies operating in risky markets and with no sales yet. Lots of SPACs aren't expected to start selling their products for years to come. This is not the case with Paysafe. They are already a huge fintech company with more than $100 billion in yearly volume and more than $1 billion in yearly revenues. They also have partnerships with huge companies such as Microsoft, and this is why we invested in them. Let's talk about BFT's price. Lately, BFT has had a huge run-up and it's sitting at around $19 a share. Our cost basis is of around $14 a share, and we still believe this is a good deal, as Paysafe is still undervalued. In fact, anything below $20 we consider an absolute steal. And the second stock is Star Capital, ticker symbol STOR. This is a REIT, or real estate investment trust, with an $8 billion market cap that operates in the net lease space, more specifically with the triple net lease model. So, what does this mean, triple net lease? Star Capital buys properties from business owners and then leases the property back to the business owners, basically becoming their landlord. However, they shift the property taxes and the insurance and maintenance costs to the tenant. This eliminates a large chunk of the risk for Star Capital. Their properties are also profit center real estate, which means that the companies who list them need them to be profitable, as they are crucial for them to conduct their business. Now let's talk about their CEO and co-founder. Chris Volk is an amazing CEO. He really knows what he is doing, and he is not just interested in being profitable, but also in helping his customers, which I believe is really helpful in making his business grow. If you have time, go and listen to one of his conference calls or one of his interviews. He explains his business so well, really making things simple. Their portfolio consists of more than 2,500 properties with more than 500 different tenants. They are located in 49 states and diversified through several industries, from restaurants to fitness clubs to early childhood education centers, not being too exposed to any sector. Star Capital doesn't go after the really big companies. They look for smaller companies with worse ratings. This means they are riskier, but also that Star will get a better return. Also, these large companies, as they have more negotiating power, usually don't show their profit and loss statements for each store. Smaller companies will have to show them. With usual leases, companies only keep the stores that make money and terminate the lease for the ones that don't. This is why Star does what they call master leases. This means that if one company has 10 different locations, Star Capital aggregates them in one master lease, or one big contract. As a consequence, companies can't just end the lease for one of the locations, as this would mean terminating the whole lease. The companies gain from this partnership with Star Capital because their costs of capital are reduced. This gives them more financial flexibility. Also, they need these properties to be profitable, as they are in the best locations. Now, some things we look for when looking at dividend stocks. First one, dividend growth. Considering it only joined the New York Stock Exchange in 2014, it doesn't have a long track record of raising dividends, but since its inception, they have delivered. Currently, they have a dividend yield of around 4.5%, and the CAGR of dividends is of 6.8%. 43% over the last 5 years. Another thing we look for in dividend stocks is resilience. You want them to be resilient. This is, you want them to withstand the tough times and be solid throughout them, maybe even coming out better in the long term. You might think that they may have been really weakened by the lockdown and the stores shutting down. This wasn't really the case. As you can see, their rent collection is above 90% and some sectors have already fully recovered. However, others like movie theaters are looking pretty bad, and I believe that will be like this for years to come. As a whole, things are looking pretty good. This could be due to their master leases or because they are not too exposed to large metropolitan areas where the lockdown measures were more severe. Finally, you want your dividend stocks to have good financials. Taking a look at their financials, the balance sheet is looking really solid. As this is a REIT, most of their assets will be in land and buildings. Looking at the assets as a whole, we can see that their assets have actually grown, something that shows the quality of work being done at Star Capital. Another thing we like is that companies don't use debt to pay the dividends. I don't like to see stocks growing their dividends just because they want to keep their investors. As you can see from their latest filing, this hasn't been the case. Even during this year, that could have been catastrophic for their business, their liabilities have stayed pretty much stagnant. Now let's summarize Star Capital. It is a dividend growth stock with a proven track record of raising their dividend. They have a proven business model which has been resilient in tough times. Not only this, but they have a great management team who's always willing to innovate. More specifically, their CEO, Chris Volk, who we believe is a great CEO. As far as price goes, we wish we would have noticed this stock back in the big sell-off in March. The price of Star Capital went from $40 a share all the way down to $15 a share. Nowadays, it sits at around $30. We believe this is a good price. And remember, if the price for some reason goes down, it's an opportunity to buy this stock at a higher yield. Thank you very much for watching. We hope you found this video valuable. If you did, please leave a like and subscribe, and we'll see you in the next one.